In April of last year, I suggested that it might be time to buy and chill with Netflix stock, as I thought it had the potential to significantly outperform the broader US indices. Subsequently, it delivered even more than what I expected. I had penciled out a 5-year framework because I'm always thinking about long-term investing. Whereas in 1 year, Netflix stock went up over 100%, far surpassing the broader US indices like the S&P 500, which was only up a couple of percent over that very same time period. But looking at Netflix's results does create a warning. And I think this is a relevant warning, not only if you're invested in Netflix, but I think the broader US indices. For example, over the same time period, the earnings for the S&P 500 have actually contracted. But let's not focus on let's say the S&P 500, in this video. I think there's a warning for investors there, but let's actually just focus on Netflix, because looking at Netflix, you see their fundamentals are okay. It's not like it's just absolutely overwhelming where you're like, wow, the fundamentals are growing 20, 30% a year and could warrant a 100% increase. You look at the increase in fundamentals and it's, 4% in the first quarter, under 3%. In the most recent quarter, margins have improved somewhat, from around 20% to 21, 22. You see diluted earnings per share, which is one of the key metrics to follow over a long time period. That's not really growing like crazy. I mean, it's favorable from 320 to 329. You see paid memberships that actually, had a very nice uptick where, they had 5 million new paid users during the quarter, which is significantly better than a year ago where you actually lost 1 million. This is part of the reason why the stock fell so significantly. People were shocked to see oh my goodness, is the business now going to start reversing? But still 8% growth overall with paid memberships. It's not keeping up with revenue, but that's partly because you're looking at new business tiers like advertising driven or lower priced members, let's say in Asia Pacific versus, let's say, North America. So looking at this, it's nothing crazy. And yet the underlying stock price up 100%. And this is why I think it's a very relevant and key warning for investors, is a lot of stock prices have moved up dramatically in a very short period. 100% in a year is a lot. And the fundamentals clearly, once again, look at these fundamentals. The fundamentals clearly have not caught up. So I think sentiment has really run ahead of where fundamentals are for Netflix. And I think you're going to see that with other stocks too. So it wouldn't surprise me if you see broader haircuts. But let's keep going. So this is my broad warning for Netflix shareholders, as well as the broader US indices. And I'm going to talk about, at what price would I find Netflix to be compelling, and, my thoughts about, where does Netflix potentially go from here. But it's not surprising to see Netflix stock, when it runs up so significantly, fall effectively 10% in just a day or two following their most recent earnings, when it's sort of underwhelming. The fundamentals aren't keeping up with sentiment. You see this over and over again. So is the bull rally with Netflix, or what I think is a bear market rally, dead? Well, I think it depends on your time frame. If you're looking at over maybe a 5 to 10 year time frame, I still think the bull thesis for Netflix is applicable, because there's structural favorable tailwinds that they have, where broadcast and cable market share, and here's a share of US TV screen time, is going to continue declining as people find more value, more bang for their buck with various different streaming services. And so I think streaming is going to continue taking market share, as you can see what's going on here with this chart provided from Netflix, where they show streaming providers are rapidly taking share of US TV screen time from the cable and broadcast users. And Netflix is clearly one of the winners, but they're not the only one. There's Disney as well, and there's also Google's YouTube. There's a lot of different providers. You also have Amazon that is also, growing quickly. Amazon previously had 2% market share of streaming. Now it's closer to 3.2%. So you can see a lot of different providers are growing. Now, Netflix is growing rapidly internationally, over 200 million paid subscribers. I think they're going to continue to gobble up users around the world. And they're also going to figure out clever ways to monetize. Most recently, they've been focused on password sharing and thinking about, how do we make more from households where they might be sharing it with multiple people, and they considered advertising tiers. I think there might be an even bigger nut to crack with Netflix, which could be from content and IP monetization. you look at Disney, and I've been thinking a lot about them lately. I talked about them in my most recent letter for my subscribers at Unrivaled Investing. And, I'm thinking about Disney, and Disney has such a huge driver from their theme parks and their products that they're selling, all those little princess dresses. And so I'm thinking about Netflix, and I'm wondering, is there going to be some sort of additional revenue, additional growth driver in the future from them figuring out a way to monetize all their content? And I just haven't really seen it yet, where it becomes a material part of their business. But if it could, I think that could create a greater growth story for the business. And so I'm very eager to see that. Maybe it involves licensing out their IP to Universal, and Universal builds a theme park. But it's clear to me that Netflix will consider something like that in the future. Just given that, they're considering gaming, password sharing, they're rapidly growing on a global basis. So it wouldn't surprise me to see them figure out another way to unlock their monetization in the future. The question is, where does Netflix go, let's say, over the next couple of years? I always try to have a long-term framework where I'm considering over, let's say, a 5-year, time perspective. But first, in full disclosure, this is not financial advice. And also a quick plug, I recently bought more of a stock just this past week that I think has over 300% upside potential that I called out to my subscribers at unrivaledinvesting.com. So if you're looking to take charge of your investment journey with compelling ideas, market insights, and an exclusive Discord community, come check it out on unrivaledinvesting.com. I also have educational investment materials where I have a personal pledge that if you have any questions or you find any gaps in the material, I will, help you with answers. I will answer the questions or make additional materials to help you out. That's with my educational materials as well. That's additional products to consider. So looking at Netflix, the current price around $4.27, which is, down about 10% from its recent high following their disappointing results. It's still around a $200 billion company. Even if profit margins improve slightly over time, even if they have high single digit to low teens growth, I'm really just not penciling out a crazy return. And this is assuming, anywhere between a 15 to 25 times earnings multiple 5 years from now. In one case, I'm getting nearly 50% upside potential. In another case, I'm getting nearly 50% downside. Keep in mind, this is a hypothetical valuation framework. Of course, the stock price can go way higher, way lower, depending on their sentiment, depending on market sentiment and their execution. But I just look at this and it's just not compelling. It's not like last year where I said, hey, I strongly suspect this could outperform, the broader US indices. Now let's take a 35% haircut to Netflix stock, and sort of walk through the same numbers. So if you're looking at around $275 per share, closer to a $100 billion market cap, then you're looking at a company where you can much more easily pencil out, let's say, 100% return over time, or you could easily pencil out, let's say, a teens return over time for the stock. So that's more of the level that I would find to be interesting. And in a downside case, you could say, well, maybe it's close to break even over 5 years. And so I think for me personally as an investor, I would consider, closer to that level. I think at this point, you've clearly run ahead where the sentiment has gotten so favorable, over the year where the stock price is up, nearly 100% now. And the fundamentals just need to catch up. We're not there yet. I think one example of a media stock that I do like, and I talk about it in a lot more detail in my latest letter, is Disney, where I think here it is, you have an example where Netflix sentiment far outstripped the fundamentals over a short time period. Whereas thinking about Disney, I think what you're looking at is a setup where sentiment is just completely collapsing relative to their actual fundamentals. And so I personally wouldn't surprise me if Disney is sort of in a similar position to where Netflix was in April of 2022, just from a sentiment perspective, where the fundamentals aren't changing that quickly. Looking at Netflix, it's 2-3% growth. And yet the stock price can change so dramatically. So, and this is part of the challenge that I think investors face. And this is how I personally, reflect on my own investment journey, is I'd rather find something that I have higher confidence is going to be growing a lot over time. Because if you get, let's say, a short-term price jump of 50 or 100%, then you're sort of faced with this question of like, well, Now, is it possible that the stock price doesn't go anywhere for a few years? So do I want to consider selling? Do I, and take the tax, payment that I'm going to have to do with that? Or do you find these other businesses where you say, oh no, I'm just going to sit and hold this for years and years and years because I think it's just going to keep on compounding. So this is the challenge that I think you're currently facing with Netflix, unless Netflix has, starts growing significantly faster than what I'm penciling out, which is, low teens growth. Maybe they'll deliver it. So far they're not. And the most recent quarter is under, I think 3%. So if you're a Netflix bull, I think you're going to need to pencil out much faster growth than what I'm doing. And I'd love to hear your reasons why. But I also think this is a very relevant warning for US investors where, let's say the S&P 500 has had a significant rally. A lot of people are talking about a new bull market. I don't think so, because when you look at the underlying fundamentals, like the S&P 500 earnings, they've actually contracted. And so you're having this huge, disruption. One thing, prices here and fundamentals are there. In long term, it's the fundamentals that drive returns. In the short term, you can get crazy noise. And that's what we've seen with Netflix. At one point, it was, everybody hated it. There was extreme fear. And next point, people are loving it. Up one over, over 100% in a year. So just such a huge and important lesson. And this is where I think a lot of investors get into real trouble, is because they focus so much on the change in sentiment in any given month. They focus on, look how great this is. But the reality is, getting tied up to the hype of like 100% price movement, this is fantastic. You're missing the more important picture, which is, what are the fundamentals support? And for me personally, by focusing on the fundamentals, it makes my own investment journey much more calm and enjoyable, because I'm just, you check on the quarterly results and you see how they're doing. Are they heading in the right direction? And the, quarterly price noise, you don't spend as much time focusing on. You just sort of check and say, hey, well, what's going on here? What's market saying? If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning into Unrivaled Investing.